Okay, hello everyone. It's my pleasure to continue our uh, daily seminars. So we global forecasting school students provide our insights and our views about several countries' economy. Today we would like to talk about our newly started project, which mean that in every week, we GFS students will update our case scenarios for the United States, and we are gonna publish it at the webpage Better Policy Project. And there you will see our views and our projections seen from the FPAS Mark II perspectives. And if people are interested in how we just come to this result, they can just contact to Asyakostanyan and Leah Humbert-Duzian. Sorry, Leah, for pronouncing your surname differently. It's kind of language issues, you know. So dear Leah and dear Asya are responsible in this regard, and they can provide you their answers to your questions, those who are interested in. So today, as I mentioned, I will briefly start from overviewing US economy, and I will just present the result and the output of collaborative work of the Global Forecasting School team. So let me just share the screen. You see my screen, right? Okay, I hope that you see my screen. Yes. So you see here the people who worked on this presentation and who worked together on updating the insight about the US economy. Here we are, and I would like to extend huge thanks to my teammates because their contribution, we are just amazing and very priceless. So let me start from the beginning now. So here we would like to just present everything from FPAS Mark II perspectives, which mean that we are trying to look everything from risk management approach. FPAS, let me very briefly just tell you what FPAS Mark II framework means in our case, for those who are not maybe aware of what we are talking about and are just listening very firstly to our live streams. FPAS Mark II framework is a new generation of FPAS framework, forecasting and policy analysis framework, which is basically the system which helps policymakers to carry out policy in a structured way. And the FPAS Mark II framework basically incorporates all of the newest challenges that policymakers are currently facing, and it helps policymakers to deal with these challenges. Basically, how it deals, the answer to this question is that firstly, it takes into account this highly elevated uncertain environment and nonlinear linkages. And how it does this, it's very kind of simple. In words, what we do is that under FPAS Mark II framework, we follow three major ingredients in policy analysis. First, we try to analyze where is the economy now. Second, we think about what are the driving forces of the economy. And then based on answering these two fundamental questions, we believe that the third and at most question that policymakers need to answer is, based on this, what they need to do with their policy, how they need to adjust their instruments in order to achieve their policy objectives, which means to achieve price stability, to anchor inflation and inflation expectations, right? So here in this regard, the FPAS Mark II framework also, as I mentioned, takes into account this highly uncertain environment there and how it does this. The answer to this question is also very simple and transparent. What we do is that we believe that it's not time of having one baseline scenario due to this highly uncertain environment. So we believe that just talking about one most probable scenario and communicating this to the public without taking into account this highly elevated uncertain environment leads policymakers to irrelevant outcomes. So here what we do in FPAS Mark II framework is that we just abandon this baseline scenario world and we focus on more scenarios-based analysis. So under FPAS Mark II, what we do is that we present several case scenarios, and we analyze the economy from these case scenarios. So we have basically two major scenarios, case A and case B. And what it means is that under case A world, we say that given current conditions and given the driving forces of the economy, we believe that inflationary forces are more entrenching, and that's why policymakers need to be more hawkish rather than market sinks. So relative to the market reference scenario, case A scenario just offers us to be more hawkish from policymaking perspectives. In case of B scenario, it's vice versa. We may think that maybe inflationary forces are not so kind of exacerbated, and maybe it's time for policymakers to follow more dovish policy paths. So again, relative to the market scenario. So here in the middle, we always have this market reference scenario, and case A and case B are just constructed based on the market reference scenario. Also, for sure, since we are under very elevated, under very uncertain environment, we take into account that there are some kind of shocks that may hit us and lead us to in a very tail risk scenario world. So we call this here case X and case Y scenarios. And if we just appear in this case X and case Y scenario, the risks of getting trapped into the dark corners are highly elevated. Getting trapped in the dark corners is not my term, as all of you know. We are using Olivier Blanchard's word and terms here. And under case X and case Y scenario, as I mentioned, we take into account the possibilities of the development that may lead us to very severe results. So this is very shortly how we analyze everything and what is FPAS Mark II philosophy in our case. So what we do at the Global Forecasting School is that we try to just adopt and apply this framework to different central banks and look everything for different countries from FPAS Mark II philosophy. At the first starting point, for sure, we start analyzing the U.S. economy, because U.S. economy, the biggest economy, and it has huge spillover all over the world. So that's why it's very important to start from the U.S. economy. So now let me just go back to the key aim of our presentation and analyze U.S. economy from the FPAS Mark II perspectives. So while we are just looking what's happening in the United States, the initial question that we may ask here is, are we in the bad times or are we in the good times for the United States? So is the bad time there or is the good time? The answer to this question is for sure very complicated, and if we look into the different perspectives, we will see and we will find out different answers. If we are in the case of, but if we believe that we are in the bad times, we may start looking into the households' balance sheets data and the credit conditions and so on. And if you're in the good times, maybe we just tell the stories from very positive perspectives. But let's just follow this question and let's try to see what's happening in the United States and what is necessary from our perspectives from the Fed to do. So firstly, is the good time or a bad time? If we look into the economic activity, we will clearly see that economy appears to be solid in the United States, economic activity. For example, in the first quarter of 2024, we saw that the real GDP growth stood at 1.6% on a year-over-year basis. And in general, over the last several quarters, we have not seen there any recession or any downturn in the economy. If we look into the kind of what we are gonna expect in the second quarter, we can just look at the GDP now estimate for the second quarter data, and we will see that even in the second quarter, based on the updated projections of the Atlanta Fed, we should expect that this solid economic activity will remain there. So in the second quarter data, it stands around at 3% based on the newest update. So now the key question is why the economic activity is so strong in the United States? What drives this economic activity to be so solid? So if we look into the details, what's happening in the United States, we'll clearly see that consumption is a direct answer to this question. It's mostly consumption-driven economic activity in the United States. If we look into the dynamics of the real personal consumption expenditures, we will realize that after 2021, while there was like huge pent-up demand due to several reasons, due to the huge fiscal stimulus that we saw during the pandemic, due to the monetary easing, due to the various reasons after in 2021, people started just spending their money. After 2021, consumption remains very solid. And as we all know, if we are just if we are just thinking about the recession without dropping consumption is unimaginable. So that's why we emphasize here this on very consumption. That's why we just focus on the consumption. Consumption in the United States, as I mentioned, remains highly strong, and especially if we just look into the decomposed way into the consumption, we will see that service consumption especially remains solid. And it's not kind of weird in the case of the United States, and not only in case of the United States. If we see the dynamics of several countries, various countries, we'll clearly see that service consumption in every country remains strong. And the reason behind this very simple and similar reason is that after the pandemic related restrictions, once we don't have this, and once people have this accumulated saving, people are just still in the pace of revenge spending. So that's why we may see this service consumption to be so strong in the United States as well. And here, as you see as well, in case of GDP now estimates, if you look into what contributes the most, solid numbers, we will see that the service consumption is the key driver and is fueling this economic activity. However, I would mention here that despite the fact that service consumption is a key driver, also we don't see big moderation in goods consumption, especially in the case of durable goods. It also remains pretty strong despite tight policy stance. Now, since I just was talking about the solid consumption, here is a very interesting story from our perspective, what's happening in the United States and what drives this consumption. The story basically begins with what's happening in the US households' balance sheets. If we look into the details of the US households' balance sheets, we will see a very interesting fact there. Firstly, what we will see that during the pandemic, there was massive accumulation of wealth of the US households. Specifically, if we just compare the end of the 2023 period to the beginning of the 2021, we will see that total US households' net wealth increased by approximately $50 trillion, which is massive number. Because if we just want to imagine what this number means, we can just look at the GDP number of 2020 of 2019 of the US. It's more than double of the GDP of the US. So what drives and what drove these net wealth to be so elevated and skyrocket? So let's just look into the details. Firstly, we all know that
There are some technical issues. Mariam will join soon.
sorry, guys. I will be sure again and just continue from the story where I stopped. You see my screen, right? Thank you. So I was talking about the reasons behind so solid households balance sheet in the United States. And I've said that this massive accumulation of the net wealth in the United States was primarily driven by massive accumulation in both financial wealth and non-financial wealth. Under financial wealth, what we mean is what happened at the stock market. And in case of non-financial wealth and non-financial assets, basically, what we mean is like mostly like real estate sector. So here, let's focus on what happened at first at the stock market and what led U.S. Financial wealth to increase. So basically, as you see at this graph as well, after the beginning of the pandemic, there was like slight drop in the stock market prices, but then it started to accumulate. Firstly, it was for sure just reinforced by these easing monetary policy conditions. Despite this, once Fed, for example, started to tighten its policy in 2022, despite this tightening policy, at first we saw some correction at the stock market, but here again we see that stock market and asset prices basically still reinforced. And as of the latest numbers, we clearly see that asset prices peaked its maximum over the last years. So these massive asset prices basically translated into the accumulated financial wealth of the US households, which in turn just increased this net wealth of the US households. On the other hand, as I mentioned, we had there this non-financial wealth, right? These home prices, as we all know, just significantly increased in the United States. And this also was translated into the accumulation of the non-financial wealth of the US households. Totally what we saw was that this massive accumulation of this financial and non-financial wealth ultimately turned into a very solid household balance sheet, which basically does not directly impact on the consumption, but from the wealth effect of the consumption, we can say that it creates buffers for the US consumers to spend money. So US consumers feel confident to keep spending. Despite the fact that we don't have exactly second quarter's data of 2024, we can still tell that given these dynamics in the asset prices, we can say that households balance sheet will still be solid, and this will in turn help us to explain what's happening in the US economy, this solid economic activity and the solid economic activity, which basically also exacerbates these underlying inflationary pressures. And this is exactly reflected in their sticky price inflation. If we look into the dynamics of the sticky price inflation, we will clearly see that recently 3 months over 3 months inflation declines, but it stands at 4%, which is far above than the 2% target. And also, if we look at the like year over year, we will see that it's still elevated. It's far above the 2% target, and its moderation pace is very low. Exactly these demand side pressures, and especially this solid consumption in the service sector, I would say, exactly just hinders underlying inflationary pressures to ease and to relax. Because we know that if you look into the what just combines and what is a sticky price inflation and what is a sticky price inflation basket in case of the United States, if you look into this, we will clearly see that the service consumption exactly draws the sticky price inflation also to stay elevated. So we clearly have in case of the United States these demand side pressures. And as I said, this 3% now cost of GDP now also, which is really far above than CBO estimate, for example, potential growth, which stands at 1.8%, still leads us to think that these demand side pressures will be serious challenge for the Fed to moderate. That's why we clearly see that the Fed still just maintains this higher for longer policy. But the key question from my perspectives and from our perspectives is, from GFS school perspectives, is it really enough? Is this policy stance enough to moderate this highly increased demand side inflationary forces? If we just elaborate more in terms of neutral rate, which is unobservable and we cannot say anything exactly, and we only can judge from the fundamental factors and from the current conditions if this is increased or not. If it's increased, we may say that it may not be enough. This current stance may not be enough. But if we just follow to the Fed's communication, and what I mean under this is that Fed likes to communicate that the long-term rates will stand at around 2.53% between these numbers, then we may see that maybe there is, due to the lagging issues in monetary policy transmission mechanisms, maybe in the later stages, we will see some kind of deceleration in demand side pressures. However, everything is uncertain, and that's why we are here and we are trying to think about this. Also, what's very important is that it's not just about its underlying inflation pace, but it's also about its relative pricing. During the pandemic period, we clearly saw the distortions in the relative prices. If we look from the Atlanta Fed's perspectives, I mean, if we just look into the CPI into the decomposed way, like from flexible prices and from the sticky prices, what we will see is that flexible prices in levels increased significantly after pandemic started. And sticky prices also follow this, because these flexible prices, we believe, was kind of warning signal for upcoming sticky price pressures. On this graph, what you see that this yellow line corresponds to the flexible price level, excluding food and energy. So excluding food and energy, why? Because we know that during the pandemic, there was a big rise in the commodity prices, and we are not just here to say the fact that everybody knows. We are here just to say and to think about what happened in details. So in case of flexible prices excluding food and energy, we still see that there was massive shift. We cannot say it's permanent or not, but it seems like that. It's significantly increased, and there is no downward trend yet, just shown. So what the key question now is that okay, we know the story of the commodities and we excluded this. Now what happened there? What draws these flexible prices to go up so significantly, and then what drove these sticky price levels to go up so significantly? So while we were analyzing this, we were just looking into the details of the CPI basket components. And we clearly just found out that one of the key drivers of this alleviation in price levels was exactly what was happening at the car market in case of the flexible prices. So car market dynamics also helps us to explain a lot of stories. At the onset of the pandemic, car prices also started to increase in terms of new and in terms of used cars as well, and their price level just shifted up significantly. And we clearly see that these car price levels are still maintaining at the higher level, and they are far above than their pre-pandemic level. And the key question here is that is it gonna revert back to the pre-pandemic level or not? Well, if you look into the history of the car prices, we will clearly see that there were several permanent shifts there. And while it was one of them was in 1980s, another was in 1990s, and we now maybe see another permanent shift in the car price level. So we can just think about this. What I believe is that due to this like increased competition in terms of electric vehicles, we may see some moderation in car price levels, but this kind of massive economic activity, like strong economic activity, and also kind of some technological shifts as well, may lead us to think that it may moderate slightly, but it's not gonna go back and revert to the pre-pandemic level. So this is also significant to take into account because it means that we will still have some distortions in relative prices. So now I was focusing on the flexible prices in this topic, but sticky price level also is elevated, as you see here. Here you see just a ratio of flexible over sticky price levels, and you will clearly see there that during the pandemic this ratio increased, and nowadays it's more or less declining, but it's just the reason behind this is just that sticky price level is also remains elevated, similar to the flexible price levels. So that's an issue. Price levels are remaining at the higher level, and it's exactly what just hits the consumer's pockets, right? So we are observing this dynamic, and we are trying to think about this in deeper manner as well. Now let me continue here. Okay, but before that, let me just go to the labor market. So I was talking about the demand side pressures in case of inflation in the United States and demand side stories. Now the story is also very interesting in case of from the supply side. And particularly the story becomes very interesting and very uncertain recently in case of the labor market, because labor market currently sends very uncertain messages. If we look at the beverage curve, which is kind of which shows us the relationship between the vacancy rate in the United States and the unemployment rate, we will see that it started to shift inward, which means that this tightness at the labor market more or less is easing. However, if we look into the wage dynamics, here we don't have this Atlanta Fed's wage growth indicated, but what we can say that it's still elevated. So wage growth still is high, remains high. Here what we have is that we see that average hourly earnings, the growth of the average hourly earnings exceeds CPI inflation. And here we still see that the risks of wage price spirals the risks are still there. So we can say that it's eradicated from there. So labor market conditions are very uncertain, and we can say, if we want to look from the FPAS Mark II perspective, that we can say that in some sense maybe it just helps us to strengthen our case A argument, and in some sense it can strengthen our case B argument. Now I would like to talk about some dynamics at the financial market. So financial market basically and financial market conditions basically are currently pretty restrictive, meaning that it moderates these demand side pressures. What we can say that based on the bank lending tightening index, it's recently started to rise again. And if we look into the decomposed way, we will see that financial conditions are pretty tidy in case of, for example, business loans and consumer loans as well. So the result of this tight financial condition is also visible in the moderation of loans, of consumer loans and real estate loans as well. For sure, the increasing interest rates, these mortgage rates also in case of real estate, and also these consumer rates, consumer loan rates, for sure just somehow helps this moderation. That's why we see the downward dynamic in case of loans in the United States, and it leads us to think that if it continues, then it will somehow just ease these demand side pressures. So it fits the financial conditions, more or less fits the more case B perspectives under FPAS Mark II. So now let's talk about more of the market's reference, what market thinks, and then let me very briefly talk about how we think based on what I just said, how we think about the case A and case B scenarios. So if we look at the market probability tracker of the Atlanta Fed, we'll clearly see that the market participants has revised up their longer-term interest rate expectations. So it leads us also to think that maybe the longer-term rates will remain high, and maybe the neutral rate is also higher than what Fed likes to communicate now. Apart from this, there are some fundamental factors as well that leads us to think, including these fiscal-related issues, including this AI developments and so on, that leads us to think that neutral rate is high in the United States, and Fed will struggle to keep interest rates for the longer term at low level. Currently, what we see that markets think that the Fed will have just first cut maybe in the next quarter, and the moderation and the path of the policy path, if you look at there, is the higher than what Fed communicates. After the recent decision of the Fed, we have they communicated in a way that we may see only one rate cut during the year. So this is what market just thinks. And now let me talk about very briefly, based on the stories that I've just said, on about our case A, case B scenarios. So given that I said that there we definitely have these demand side pressures, we think that the strong demand may persist, and the strong demand will be exactly fueled by this solid household balance sheet, I mean these net wealth. And if we don't see just moderation in asset prices, which can be validated by higher neutral rate currently, if we don't see this, we may still stick to this case A scenario, because these high asset prices will ultimately be translated into the solid household balance sheet and will fuel consumption. Also, as I mentioned, this wage growth dynamics also keeps us to think that labor market remains tight. So under our case A scenarios, we have taken into account these facts. But in case of this scenario, as I've said, we may think that this tight financial condition will just impact these demand side pressures, and we will soon see the moderation in economic activity because. By the way, I've just missed that. Recently, what we see is that the delinquency rates of several loans also are increasing, and this means that financial conditions may further be tightened, and risk appetite of the commercial banks will further decrease. This will be translated into the lower credits and ultimately into the lower consumption. Also, this labor market slightly indicates that maybe we will see some moderation from the supply side pressures. So based on this, our case A and case B scenarios look as you see here. So we think that under a case A scenario policy, Fed funds rates will increase up to slightly. We can say it also just stays at the current level for a longer period. And what I would like to mention here is that under case A scenario where we say that the strong economic activity just remains for a longer, it may just turn into the higher real rates, just people will just investors will just demand higher real rates for the longer term, and also these higher real rates mean that maybe the neutral rate also may be the reflection of the increased neutral rate, and that if the neutral rate is increased, the terminal rate of the Fed rate stands around at 4% in under case A scenario. So if the real rates will increase, this will be translated into the increased in premium as well. And other case A, we will have this unemployment rate also will go down in the short term, because in the short term we will still have this generalized excess demand condition, and then it will just moderate, and it will just go up to the 4.2% around, which is basically in line with CBO's Nairu estimate. Under case B scenario, what we can say is that it's below the market reference scenario, but under case B, we follow more dovish scenario development, and we may see that Fed will just decrease its rate faster than what currently market thinks, due to this financial condition will help them in this regard. And then what we will clearly see that this unemployment rate will be higher there, because these financial conditions will be just can be translated into the drop in the asset prices as well, and we may see some big correction in the stock market, which will be translated into the lower consumption, and we will clearly see this low economic activity, which means that we will have higher unemployment rate. As a result, we believe that in case B scenario, the inflation will go down. It will be lower than the target in the shorter term, and it will go back to the target over the medium term. This is our case A, case B scenarios here, as you see. Basically, as I mentioned, once we receive any new information and once we think more, we may just change this, and the next week we will also talk about our updates. Maybe not me, my other teammates. And lastly, before just giving floor to my friends at the Global Forecasting School, let me talk about the case X scenario as well that we are taking into account recently. Basically, it's a tail risk, because here we assume what if, for example, this real rate will exceed to the growth rate as well, and if under this higher long-term interest rates, real interest rates, if just the US government will continue to have a fiscal deficit, then it may turn into the fiscal unsustainable position, and ultimately fiscal deficit will become unsustainable, and it will just turn into the big recession here. And this big recession is hard landing scenario in that case, and this hard landing scenario is for sure case X scenario under FAS Mark II framework. So this was all what I wanted to present today. And once again, thanks very much to my teammates who basically prepared this story with me as well. And thanks for their huge contribution here. If you have comments, I would be happy to hear from you, because all of you, we are just working on this, and I'm sure you will have your own perspectives about this case A, case B scenarios as well. Maybe Leah-Jen, if you just, because your contribution was really high and like priceless there. So Leah-Jen, please.
So thanks, Mariam-Jan, for a very interesting presentation. I think you summarized everything greatly. And I agree that there is a very big uncertainty currently. And by uncertainty, I don't mean only uncertainty about the future economic developments or conditions, but also uncertainty around the current underlying economic conditions. So we can see that on one hand, some of the indicators, as you mentioned, suggest that the labor market is still strong and the economy is operating under excess demand conditions, while some of the indicators suggest that significant cooling is on the way and there is no big excess demand pressures, and there is little chance that inflation pressures are going to increase in the future. I think in that sense, uncertainty is big and it's impossible to talk about some baseline view in this situation, which is also highlights the importance of our Mark II framework. But I think more interesting question for me, and maybe it's a bit of a policy question, but still a very relevant and interesting one from the perspective of risk management. The question is, which type of policy error might be worse for the Fed? So the policy error when Fed starts to ease policy stance quickly, and then it happens that the underlying economic conditions and the inflationary pressures are still there. Neutral rate is higher and the inflation starts to reverse and increase. And Fed understands that the problem of inflation hasn't been solved yet and starts to reverse the policy by increasing interest rates again. Or the policy error where the Fed keeps interest rates higher for longer, and then it happens that the economy starts to go into a recession very quickly, and Fed realizes that a bit late, and then he realizes it a bit late, and then starts to reduce quickly its policy rate, its interest rates. So I want to say that from risk management perspectives, I think given the initial conditions of the economy and the fact that inflation has been above the target of for the last 2 years, the first type of error will be more costly, as it in that situation inflation expectations may adjust upwards, making the trade-offs for stabilizing inflation and of course output more costly for the Federal Reserve. So maybe that's all. You covered all the parts of the US economy very well. Mariam-Jan, again, thank you for your great presentation.
Thanks, Leah-Jen. I think you mentioned a very interesting case. What if there's a delay in realizing that they have to tighten more, right? Like they are making a mistake. And what if the Fed again makes policy error? Because we all more or less all are agreed that central banks, not only the Fed, but all central banks made some of them bigger and some of them not so significant mistakes. And what if scenarios are exactly now very interesting, and due to this uncertain environment, we need to carry out this. I absolutely agree with you. Thanks, Leah-Jen, for your very interesting insights. Maybe Anna can provide her perspective if she agrees our case A or case B, or if she thinks that maybe there are some other types of risks as well that we need to take into account.
Thanks, Mariam Can. So I think you covered all topics. I can mention that for me it's very interesting topic like fiscal policy and how it will develop on the background of elections. So, but I agree with case A and case B. I have no more comments.
Yeah, I agree with you that what will happen after the election and before the election as well will significantly define the situation in the United States. I absolutely agree with you. Rudik, we were also working on this Not a Bad Deal book together, and maybe you may have your different views, or how do you just look case A, case B for the United States?
Yeah, my views are also aligned with the views that we have heard about case and case Bs. The consumption still is like in high levels, driven by different factors and stuff. We see some contraction from financial markets, but it's not still enough. So case A risks are more currently. So basically, I agree with all these points, and I'm now looking forward to kind of think through all these uncertainties further to understand like which way this risk will like continue to grow, or like which way the economy will continue to like strive.
Okay, thanks, Rudik. Maybe Sergey and Anna are also watching here different central banks as well, but before maybe we may ask them to share their views. What's happening in the case of the country they are watching? But before that, I would like to hear from you as well, Sergey and Anna. How do you look the case A and case B perspectives for the United States? Maybe Anna, you start.
Yes, thank you. Hello, Mariam, and hello, everyone. Thank you for interesting discussion. And as you mentioned in the beginning of your discussion, we are central bank watchers, and we each have personally allocated a specific country. So, for example, I have Czech Republic. For the United States and for the Czech Republic, one like common thing I wanted to comment also is about, we had discussion yesterday about the elevator economics, and we've been discussing about this issue. I find this particularly interesting for Czech Republic is that United States currently has 5.25% policy rate, while Czech Republic also has the same. And this could mean sort of this capital outflow from the developing countries. And that is why, as you mentioned also in your presentation, we analyze US economy because it's important for countries like us to look how it is developing, the macroeconomy is developing in US. And currently we see a lot of uncertainties in the US. We see this heightened uncertainty, and that is also why we emphasize the role of Mark II, that this heightened uncertainty which countries like Georgia, Armenia, and Czech Republic is facing. So, for example, the current uncertainty that US policy rate is roughly same as the Czech Republic, and that's why it's important to analyze sort of where it is heading, and whether these developing countries like Czech Republic should maybe increase their policy rate or not to maintain this capital flow as it has right now. So regarding case A and case B scenarios, that is also why we emphasize the role of Mark II in these countries like Czech Republic, that For example, I always prepare case A and case B scenario, and case A scenario for the Czech Republic is where we have heightened elevated inflationary pressures, which we currently see from the Czech Republic's current data, and that is exactly why it's important to analyze case A and case B alongside with some taxonomy of shocks. And this taxonomy of shocks that we saw during COVID-19, that it's not something that is sort of irrelevant, but during COVID-19, we saw that it is exactly very relevant and very important because we saw during COVID-19 that things were developing in a way that nobody really expected. So that's why exactly case X comes into place. And thank you for analyzing this case X scenario for the US economy as well, because it's mentioned analyzing US economy correctly and emphasizing this uncertainty is very important for our countries as well as many other developing countries as well. So that is why we are working on this topic. Thank you.
Thanks, and I think you very well explained the importance of, for us, countries like Georgia and Armenia, also why we need to very, very carefully observe what's happening there and take insights and provide our insights as well. Thank you very much. It was very interesting. And lastly, I would like to ask Sergey, who is also working on the case of the Bank of England and also analyzes the policy action that they are carrying out. But before that, maybe Sergey, I'm curious, what do you think about the cases that we presented here together? Because it's, as I mentioned, it's the product of the collaborative effort. And I'm curious, do you see any other kind of risks that may pop up there and we can consider in case A or case B or case X scenarios in case of the United States? And also, I'm really curious to compare the Bank of England's policy to the Fed's policy in some sense. I would hear this from you as well.
Thanks, Mariam. I think all of you discussed the US very well. I think it was a very comprehensive discussion, so I think I cannot add much here. I would like to just emphasize maybe my personal view about some strengths of the risks that we considered here. I mean, technically, I'm agreeing to all the risks that you listed. I think for now, they very well cover all the possible developments that you could see. Specifically, I'm really glad that we discussed this case X scenario, which sometimes is overlooked, this development in the fiscal sector, but it's important. In my perspective, the tightness from the labor market, in general, the labor market needs to be analyzed a bit more deeply, which I think Leah is doing, and thanks for that, because it kind of gives us mixed signals, right? If like some indicators indicate towards cooling, some indicators indicate towards labor market remaining tight. And I mean, it's important because exactly the tightness of the labor market will translate into the wage growth. And in the end, it will have an impact on this sticky prices. And that's exactly what would indicate whether we will have the disinflation process accelerating or decelerating even more. And in the end, this will have more direct implication for the monetary policy. Another risk that I think is really crucial alongside the fiscal theme is the neutral rate, I mean, uncertainty around it. Because again, if the neutral rate is way higher than what's currently assumed, and we have all the facts to suspect that it could be higher than what Fed estimates, then again, the monetary policy, it will have way different consequences for monetary policy, very direct, and then Fed might need to tighten further to again accelerate this disinflation process and anchor the economy. Just to compare now the US and the UK maybe, I will be very brief because we have discussed this many times. Let me just highlight one difference and the common trends that we observe in this economy. Well, the common theme is this tight labor market and service inflation elevated. This is like very common, and in a sense, this tightness in the labor market, which is especially reflected in the wage growth, which remains elevated. There are different reasons behind this, one of them being the very strong labor unions, maybe, but regardless of the reasons, the result is that the wage growth translates into higher prices, and we see the underlying inflation measures, services or the non-trade sticky prices elevated and with very slow pace of normalization. And this is problematic for the Bank of England. However, now here comes the difference between these two economies. And this is where the Bank of England has kind of higher trade-off than the Fed maybe, because in the US we see quite robust economic performance. We know it's coming from consumption and this story. But in the United Kingdom's case, it's the absolute opposite. The GDP growth was very weak for almost a year and a half, if not more. And this trend continues even now. Even we don't have like quarterly measures of the GDP growth, but this month estimates that Statistics Office publishes indicate that there is nothing changed much. This growth remains weak, which comes from the tight lending conditions, credit conditions, and this translates into people's ability to consume or spend. And because of this, Bank of England is in kind of more constrained because it needs to tighten policy, maybe tighten policy further to anchor economy, but on the other hand, it's very costly given the current performance. So just to finalize, like cases in case of United Kingdom are very similar to US. The only difference is that, well, in case A, it stands on the assumptions of tight labor market and inflation being very rigid to normalize back to the target. But the case B is standing on the assumptions of this weak demand side of the economy continuing to persist, and therefore this supporting and at the end this disinflation process and inflation normalization process accelerating. So that's all about the UK and US.
Thanks, Sergey. I think you mentioned very interesting. You said something very interesting. They are trying to, by tightening more to avoid this loss. They are trying to avoid, like, minimize their loss. I guess this was kind of the sentence that you said. But I have a question, maybe not directly. Currently, I don't need the answer maybe to this. Maybe you answer this later as well. But what is more costly from their perspectives currently to leave elevated inflation pressures there, which will then later may demand and require from them to tighten more and to just generate costlier results if they are seeking in terms of like sacrifice now what they have to make currently. If they tighten more, maybe they will need more to sacrifice later. Because they are also, by their polls, they may have this loss in credibility, which we all very well know that will result in later to have, if they want to re-anchor inflation expectations, this will just require from them to have more aggressive steps. So this was kind of comment that you said. Thank you very much for your interesting comments and providing your insights. I think today this was all what I wanted to share with you, and I would like again to emphasize that this was teamwork. This was the work that GFS teamed together combined, and we are happy that we are going to continue working together on these issues. And then next Friday, we'll again present our updated case A, case B scenarios and our perspective about the US economy. And once again, if people who are watching us are interested in the details of our case A, case Bs, and may have some question, they just go on internet, search for the Better Policy Project webpage and see there our cases. And in case of questions, just contact to Asya and Leah, as I've said. Thank you, all of you, for your effort and for your participation, and see you then next week.
Thank you all. Thank you.
Thank you, Maya. Thank you all.
Thank you, see you.